So you're thinking about buying a house. Can you afford the payment? Well, that's what we're going to talk about today and why that's important. Hey everybody, this is Eddie Sprouse from your best friend in the mortgage business. And I'm here today to talk about the ability to repay. That's actually not just something I made up. That's something that the Consumer Financial Protection Bureau, the CFPB, established some time ago, is to make sure consumers have the ability to repay their mortgage loans and to make that payment each and every month. And it goes hand in hand with another rule that they have called the Qualified Mortgage Rule. And you need to know what these things are and how they affect your ability to qualify for a mortgage. So the ability to repay rule basically in a nutshell says that when everything is said and done, you're reasonably going to be able to make that mortgage payment. Now you may say, well, hey, I know what my budget is. I know how much I make a month. And sure, I can make that payment. Well, it's not as easy as that. There's a lot of things that lenders have to consider to make sure that your mortgage falls within this qualified mortgage rule and the ability to repay rule. So one of the things the CFPB did when they first established these rules is they eliminated several types of mortgage products that were pretty common prior to that affected the consumer negatively. Things like interest-only loans, where for the life of the mortgage, you were just paying interest. You never paid down anything on the principal amount. And what that meant for you is if you ever wanted to refinance or sell that property, you would end up owing as much on it as you did when you signed on the dotted line to get that mortgage, whether it was 5 or 10 or 15 years later. You've not paid down anything on the mortgage itself. And if home prices stayed flat since you signed or went down, which is even worse, then you may be upside down on your loan and you may not be able to get any cash out of the sale of the home. So they did away with interest only. Along with that is something called negative amortization. So on a negative amortization loan, the amount of the principal balance of the loan actually went up over time as you made your payments because your payments weren't doing enough to lower the principal and interest. So those are gone, and that's a good thing. Another thing that got hacked and slashed was balloon payment loans. So these would be loans when you would agree that you'd make this payment for 5 or 10 years, and then you would have to refinance the home in order to make this balloon payment, or you'd have to pay it off, or you'd have to sell the home. So all this could put the consumer in jeopardy. So that's gone as well. There's lots of these kind of things out there that were done in the past that are no longer done, and they're for your benefit. Another thing that lenders have to consider when they're looking at the ability to repay, it's not just your income, okay? They're going to be looking at your assets. They're going to be looking at your other debts to make sure that you can afford not only the new principal, interest, taxes, and insurance payment on this house, but with all the other debts combined, that your debt to income ratio is not over a certain threshold. So again, the goal with these rules is to make sure that you can reasonably afford to make your payment. They're going to look at things like your work history, see that you've got a stable work history and stable income. They're going to look at things like your bank account to make sure you're not putting yourself in financial jeopardy by using all your cash reserves that you have in order to purchase a home. So all those things go into that ability to repay. If your mortgage features an adjustable rate feature, okay, so at some point that rate could go up, you have to qualify on that higher rate. Whatever that adjustable rate can go up to, that's what you have to qualify on. Again, lenders are forced to look at it through the lens of a worst case scenario to make sure you can make that payment. So it's not as easy as just filling out an application and submitting it to your lender, showing them some income and asset documentations. The lender has a responsibility not only to local state authorities to make sure that their loans fit within the qualified loan parameters, but they also have a responsibility to the federal government who establishes these ability to repay rules and qualified mortgage rules. So if you have questions about that, my contact information is at the end of this video. I'd love to talk to you more about it in detail. And it's really important for you to know the ins and outs of how these things work so you understand where the lender comes up with a budget for a home for you and why you may or may not get approved for a certain loan amount based on all these factors. I hope you're having a great day. God bless you. And remember to like and share these videos and subscribe. It's free today. Come on.
I want to buy swaps on mortgage bonds, credit default swap that will pay off if the underlying bond fails.
You want to bet against the housing market?
Yes.
Why? Those bonds only fail if millions of Americans don't pay their mortgages. That's never happened in history. If you'll excuse me, Dr. Berry, it seems like a foolish investment.
Based on prevailing sentiment of the market, banks, and popular culture, yes, it's a foolish investment, but everyone's wrong.